Hey traders, Mike here. In today's video, I'm going to explore a trading strategy that allows traders to generate quick profits without too much risk. So rather than try to forecast the direction of an asset, the approach of arbitrage focuses on price discrepancies. So in this video, I'm going to tell you exactly what arbitrage trading is, how to look for price discrepancies, and teach you 3 arbitrage trading strategies. Most importantly, I'm going to show you how to generate profits through arbitrage trading. So let's get started. First off, let me share with you what arbitrage means in trading. It's a strategy used to capitalize on price discrepancies and inefficiencies that can exist between different markets, assets, or securities. The objective of arbitrage relies on exploiting temporary imbalances in prices, allowing traders to generate profits with little or no risk. Let me give you a simple example. Let's just say that you can buy an apple for 50 cents at market A or buy the same exact apple for 60 cents at market B. Well, an arbitrage trader will notice this price discrepancy and sees an opportunity to make money. Now, the trader will buy the apple for 50 cents at market A and then immediately try to sell it for 60 cents at market B. The arbitrage trader locks in a profit of 10 cents per apple and keeps on repeating this same exact process multiple times to maximize his or her profit as long as the price discrepancy exists. Now, arbitrage opportunities exist when identical assets or securities which should be priced the same somehow are priced differently due to market inefficiencies, time lags, or perhaps premiums placed on an asset such as Bitcoin. Now, in my past videos, I profiled how in 2017, Sam Bankman-Fried made over $20 million in arbitrage trading profits by buying Bitcoin on a US exchange and then immediately selling it at a higher price on a Japan exchange. And this is a perfect example of an identical asset that is priced differently in 2 different countries and how arbitrage traders exploited this for huge profits. So the question you might be asking is, how do I look for arbitrage opportunities? When looking for arbitrage trading opportunities, you need to consider the following. First, you must identify the financial market that you want to explore for potential arbitrage opportunities. Now, this could be the stock market, commodities, forex market, or cryptocurrencies. Then, look to see if there are price discrepancies of the same asset across different markets or exchanges. For example, Bitcoin prices are priced differently in each crypto exchange, or a company's stock is duly listed in both the US stock market as well as in another country's stock market. The third thing is to assess the costs and risks. Take into account the transaction costs involved in executing the arbitrage trade, such as trading fees, commissions, and spreads. This way you can assess the overall potential profit from the arbitrage trade. As well, evaluate the risk associated with the arbitrage opportunity, such as liquidity risk, counterparty risk, regulatory risk, or any other potential pitfalls that could impact your ability to execute or scale the trade successfully. Now, once you have identified a potential arbitrage opportunity, develop a trading strategy to properly time and execute the trades in 2 different markets. Now, I'll share a few arbitrage trading strategies later on in this video. The 5th thing you should try to do is to automate your trades where possible. Now, arbitrage opportunities can be short-lived, so it's often beneficial to automate your trading strategy utilizing algorithmic or high-frequency trading techniques. And this allows you to react quickly and efficiently to market conditions and capture the price discrepancies before they disappear. Lastly, before you commit significant capital to an arbitrage strategy, it's essential to backtest your approach utilizing historical data. And this helps you assess the viability and profitability of your strategy over time. Let's now talk about the types of arbitrage opportunities and the type of strategies that are best deployed for arbitrage trading. Now, the most obvious arbitrage opportunity is geographical arbitrage, which exploits price differences of an asset listed on different exchanges. Now, given the decentralized nature of cryptocurrency exchanges, price discrepancies can occur between different exchanges. So, for example, here you can see that the price of Bitcoin is listed on 10 different exchanges with varying degrees of prices. So the simple strategy here is to buy Bitcoin at the lowest price, which is at Gemini for $30,633.15, and simultaneously sell Bitcoin at $30,757.21 at Bitstamp, thereby profiting from the price discrepancy of $124.06 per Bitcoin. However, you would need to take into account the transaction fees that the exchanges charge, as well as the large sum of capital required to make the trade worthwhile. Another type of arbitrage opportunity is dually listed stock arbitrage. And this type of arbitrage occurs when a company's stock is listed and traded on multiple exchanges in different countries. Now, due to factors such as exchange rate fluctuations, different trading hours, and market dynamics, price discrepancies can arise between the two listings. Now, you can take advantage of these discrepancies by simultaneously buying the stock on one exchange and selling it on the other exchange, aiming to profit from the price difference. For example, the company stock Royal Bank is listed in both the US and in Canada. And here's a chart of Royal Bank stock that is listed on the Toronto Stock Exchange in Canada, and the orange line is the stock listed on the New York Stock Exchange. So you can see here that the US listed stock generally outperforms the Canadian listing throughout 2023. And this could be due to currency rate differences between the US dollar and Canadian dollar, as well as days when there is a holiday in the US versus Canada. However, the strategy is simply to buy the US listed stock and sell the Canadian listing. Now, the downside of this type of opportunity is generally nowadays with technology and more efficient markets, there are fewer and fewer price discrepancies amongst duly listed companies. Another type of arbitrage opportunity is called cash merger arbitrage, which involves taking advantage of price discrepancies between a company's stock price and the cash offer made by an acquiring company in a merger or acquisition deal. Now, if the market price of the target company's stock is trading below the cash offer price, you can buy the stock. Now, the goal is to profit between the current stock price and the cash offer price as the merger progresses towards completion. A good example is in 2016 when telecommunications giant AT&T announced its intention to acquire media conglomerate Time Warner. Now, AT&T made an all-cash offer to acquire Time Warner for $107.50 per share. Now, as you can see from this chart, following the announcement, the stock price of Time Warner shot up to almost $100 per share, which were prices 8% below the acquisition offer price. Now, due to market uncertainties and regulatory concerns, prices fell even further as low as $85 per share, and this is when you as an arbitrage trader can buy shares of Time Warner at prices below the acquisition offer. Now, once the merger talks progressed and regulatory approvals were obtained, the stock price of Time Warner gradually approached and eventually reached the acquisition offer price of $107.50 per share. For you, this would result in a profit of at least $7.50 per share, or as high as $22.50 per share. The obvious risk in this type of opportunity is if the acquiring company decides to abandon its purchase or merger, then the stock price of the target company's price would fall. However, you can minimize the risk by buying a put option contract at the acquisition price. Overall, arbitrage trading plays a crucial role in promoting market efficiency by aligning prices across different exchanges and markets. While it requires specialized knowledge, advanced technology, and swift execution, successful arbitrageurs can profit from exploiting temporary pricing discrepancies, contributing to the overall liquidity and stability of financial markets.